Welcome everyone. Welcome to this episode. I have with me, of course, Mr. Rahul Baijal from HDFC AMC, and we are talking at a point which is very interesting for the markets. I think this is the biggest correction that people of the COVID generation, so as to say, have seen. I call COVID generation because a lot of us have started investing post COVID when we saw a correction, and since then, I think we have seen corrections, some smaller corrections, of course, but this is probably the longest lasting. And then we saw some 5% fall in a single day. That in itself was a new experience for a lot of people. So we requested, of course, Rahul sir to help us understand this scenario better and share his outlook as well. So let's get to the meat of the topic right at first. What is happening right now, and what do you think is the outlook for the markets from here on?
So I think we are in a very uncertain environment globally. So I'll split the environment in two parts. One is the local environment, which is more easier to get a grip on, and then bring in the context of the global environment. So firstly, as far as India is concerned, I think if I split this also into the long term and the medium term, I think the long term story hasn't changed. We continue to remain, probably the most attractive emerging market to invest in. The 10-11% nominal GDP growth story over the next 5 years. So that story remains the same. Short term, last few months, or rather last few quarters, we are having some sort of a slowdown, and we've had 3 quarters of earnings downgrades, and valuations were rich after the phenomenal run we saw in the markets from March 23 onwards. So we were in a corrective mode since September, October. So that was happening at the local level, and I think we were coming close to the end of the downgrade cycle. Valuations had also become attractive, especially for the large caps, and broader market. I think a lot of the froth had gone out. Some froth was still left, but post the correction, stock picking was getting more attractive in that space as well. So given that backdrop, now we have this new global environment which has emerged, and like we have been following, it's an uncertain environment. A lot of questions are unanswered in terms of is there going to be a tariff rollback? Is there a recession coming? What is the probability of the recession in the US? And how long this escalation in the trade war between US and China happens? So a lot of questions and a lot of unanswered questions, unfortunately. So I think this will keep the uncertainty high in the markets in the short term, and markets don't like uncertainty, as we know from the history. So clearly, volatility, will be high in the short term, depending on the announcements, depending on how the views change. So I think we'll have to live with volatility in the short term.
Right. So continuing on that question itself, do you think this volatility, this uncertainty that we are seeing, is this can this be called a part and parcel of the market that comes every once in a while, or is there actually a deeper structural shift happening, be it within India or the global macro trends?
So I think what was happening in the Indian context before these events happened was, a normal correction which was due for a long time. And that got triggered because we had the earnings slowdown locally, and we had a big phase of FI selling happening as well since October onwards, because there was a one-way move from emerging markets to DM around the Trump elections. But what's happening now, I think, is not normal. It is clearly a tail event, as we call it in statistics. And you have these tail events once in few years. The earlier tail events were during COVID and then during GFC. So there is clearly a lot of a new normal potential, a new framework potential behind this, and more so at the US level, and how they are approaching the trade relationships with the rest of the world. So the trade war 1.0, which happened in 2018-19, was mainly a US-China confrontation. But what we are seeing now in the form of tariffs, which have been rolled out across the world, and with 60 countries reciprocal tariffs as well, over and over the 10% imposed for most of the world. This clearly is a reset of how trade is going to be done in the world. There was an earlier regime of under WTO over the last 5 decades, and this is a new way of thinking and framework. So clearly, it's a big reset, and this will have growth implications, inflation implications across different economies, and therefore equity market behavior implications as well. And this will also have fixed income market implications, as we are beginning to see in the form of some weird moves happening in the US Treasury, especially today and yesterday. So clearly, this is not a normal correction. This is a tail event. A lot of unanswered questions and a lot of ifs and buts. Each day, each week is going to be a new week, a new day, and we have to keep recalibrating and watch our way cautiously through this in the short term.
Absolutely. Before this, so there's two types of volatility or corrections. Let me put it this way. One is the one that we have seen recently in the month of April, since this financial year has begun, and it has been super volatile. And before then, there was a correction. There was a prolonged correction that we saw. March was an exception, but before that, I think for continuously 5 months, we saw Indian equity market falling, and that was, I think, in the last 30 plus years, this was one of the most prolonged correction that we saw. And a big reason of that prolonged correction was attributed to FIIs. I have two-part question. One, do you think that FII selling that we were seeing, that everybody was talking about a while ago, has that abated now? Is one. And or second is also related to it. Do you see it as a part of that prolonged correction itself, this as well, or these are two separate events?
So I would say, short answer, these are two separate events. Firstly, the first round of correction, which began around the elections in US, which was so-called the Trump trade, that began sometime in October, and we had close to, I think, $12-13 billion of selling in the October, November, December phase. And then Jan began, and that one-way move from EM to DM, especially to the US markets, continued. And we had another heavy round of selling in Jan Feb. So we had almost $25 billion of FS selling over a matter of 5 months. And mid-March onwards, we had actually seen the FI selling intensity reduce a lot. And we even saw a few days of positive figures as well. And my sense then was that probably we are coming towards the end of this heavy FI selling, and I was getting more comfortable on that front. And then you had this tail event, and again we've seen FI selling pick up over the last few days in April. And I think this is again a part of the overall risk of selling, which you see. Especially when concerns develop around emerging market currencies. Typically, in a risk-off environment, there is a tendency for the EM currencies to depreciate, and this time you have the concern on yuan depreciation as well, because given the trade war, some expectation is that Chinese may devalue. So all these are playing on the minds of EM investors. So I think it's normal to expect another round of risk off, which we are seeing from the FI selling perspective. But having said that, I think fundamentally my view is that India should come out fine over the medium term as far as the positioning with the trade partners is concerned. There is some narrative of a trade deal which has been in talks with the US for a few weeks, few months now. And we'll get clarity on that in the following months. Like will be the case with other trade deals, as long as there's no U-turn, from the Trump team on this policy approach. So when that clarity emerges, I'm pretty confident that India will emerge with a stronger trade equation and a greater visibility on how Make in India and manufacturing mix in the India's GDP can keep rising and help boost the job equation as far as Indians is concerned. So medium to long term, I think we should come out stronger, but short term markets are correlated, and I think we will be a follower of what happens globally in the short term.
Right. Talking a little sector specific, I think every cycle, every boom and recession has their own leaders. We and market flavor also keeps changing. At some point, IT was a favorite. During COVID era, it was pharma. Then came defense and PSUs for a while became the darling of investors. For right now, I think people are talking about gold being one of the best asset classes available. Uh, what do you think is gonna do well in the coming, let's say, medium term, medium to long term?
So I think from an India perspective, if you leave the trade linkages apart, I think we have a lot of good themes going on within the country, and my focus in portfolio positioning is more to be inward looking and less outward looking in terms of portfolio positioning on a bottom up, top down basis, given the uncertainty because of the trade issues. So within the domestic themes, I think there are a few multi-year themes which are looking good. Clearly, within financial services, I think we have seen the regulator becoming more accommodative. There was a stance change today, and I think more rate cuts ahead, and liquidity environment should keep getting better as we go into FY26. So that is good news from a deposit growth and credit growth perspective. So clearly, the large lenders, both in the banks as well as NBFCs, should do well in this environment. Within this space, the affordable housing theme is also looking good. Then, if I go beyond financial services, I think the digital commerce environment in India is very exciting, and a lot of the business models which are using the digital and commerce ecosystem in retailing and in home delivery solutions and many other areas in life insurance, I think have a long runway of growth. So I think times like these, volatility are using to my advantage, build positions in some of these digital commerce plays, which usually correct, especially when there is volatility around Nasdaq and global tech names. So I think that's a multi-year runway for India. Then I think the healthcare space also, hospitals within the consumption space, hotels, those cycles are also looking good. Short term, I think real estate and the capex cycle, I think takes a pause, but I would say after this prolonged pause, even the real estate upcycle and the private sector capex upcycle should also look good. So opportunities emerge in those areas as well. So that's the way I'm looking at some of these strong themes in the domestic ecosystem.
Absolutely. Right. Let's talk about growth versus value investing, because for a while when the markets are bullish, everything is going up, people cling on to growth investing, that this is even if it's 100 rupees right now, 100 PE right now, it'll go to 150. And now that markets have corrected, people switch to value investing. Yes, there should be a margin of error, margin of safety available. Which one do you think retail investors should stick to?
So, market has its phases when it rewards one style versus the other. But I would say if you look at the long term, in general, most investors in India are, somewhere around this GARP spectrum. Some pay more attention to price when they're entering, and some pay more attention to the quality and the runway of growth, and they are okay compromising on the entry level valuation. But essentially, India is a growth market for the last 2 decades, and that will continue over the next 10 years as well. And now within this, I would say if you were to fine tune further, I think there was a phase in 20 when a lot of price to book P multiples had become very attractive, and many stocks belonging to some of the areas in which a private sector is not very active in the PSU space were also beaten down. So we had a strong value run from mid 20 to mid 24, and a lot of re-rating has happened in a lot of those names. So my sense is that I think the best of value phase is probably behind us in many of these names between mid 20 and mid 24. And going forward, I think quality combined with visibility of growth and reasonable valuations is what should do well. And that's how I'm approaching my portfolios as well.
Absolutely. Okay, let me put it this way. Which mistake do you see retail investors making the most? Most common mistakes that you have seen, and or maybe the most dangerous, whichever you feel that they should always take care of, not to do this.
I think these are times when emotions will, play a big role in how we, take decisions, especially in the short term. So I would say managing emotions in these environment is pretty critical. One common mistake is during these times to think about stopping SIPs. I think that is clearly a no-go area. And in fact, times like these is when one should think of adding on to some lump sums when one feels valuations are really attractive and there's a lot of fear in the market. So I think in the short term, these opportunities will emerge. So getting too fearful is something one has to watch out for in the short term. And similarly, on the greed and fear spectrum, when things get really euphoric, like they were middle of last year, the learning again is that one shouldn't get too carried away with the themes and momentum which are flavor of the market. And typically, once you ride those horses, they sometimes throw you off sometime later. So I think managing emotions is critical. Secondly, from a longer term perspective, my learning has been that the earlier you start investing, you are. I think it's a healthy thing. And I wish I had started investing much more and much earlier in my career. So start early and begin with SIPs early and keep staggering and boosting your SIPs every year as your savings capacity increases. And use the greed and fear in the market, the corrections and the the euphoria in the market to do some lump sum top ups and lump sum withdrawals to overall boost the SIP return profile. I think that's the advice I would give to the retail investors.
Absolutely. Well, thank you so much for that. This has been an absolute pleasure talking to you, sir. I hope you'll allow us more such sessions in future.
Sure, my pleasure too. Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
Please note that mutual fund investments are subject to market risks. Read all scheme-related documents carefully.